Okay, so far we have been looking at the yield curve as it was in December 2021 for the US Treasury bond, and we were using that to focus our discussion. However, just to make sure that we understand that that's not the only type of shape that you might see in a yield curve, right? So these are four different yield curves of the US Treasury bonds, but at different points in time. So, for example, the first one is in May 2011, where we see that the structure is similar to what we had seen in the 2021 as well. Basically, you have an upward yield curve, right? And this would be corresponding to the normal case because this is how yield curves look like most of the times. However, you do have other situations. So, for example, in January 2007, you had the yield curve being basically flat, okay? In December 1980, you had the yield curve looking actually inverted in the sense that the slope became negative, right? So higher maturity bonds were actually giving lower annualized rates. And you might also have, as it was the case in June 1979, a yield curve which is hump shaped, right? So let's look at like this more detail. So these are basically the four major kind of scenarios that can happen. So when we say that we have a flat yield curve, this was the case, for example, in January 2007, there's basically little to no difference between short-term and long-term rates. If you have an upward sloping curve, which we had, for example, in December 2021 or in May 2011, this would correspond to the case where the short-term rates are lower than the long-term rates. You might often have, sometimes actually, you might have this downward sloping case, which was the scenario in December 1980, where the short-term rates actually were higher than the long-term rates. And sometimes you might have this humped case where the short-term rates and the long-term rates were actually more than the medium-term rates. So this is where you can see, right? So this medium-term rate around 4 years' time was actually lower compared to the short-term and the more long-term rates, right? So in terms of how frequently you kind of like see these things for the, let's say for the US Treasury bond scenario at least. So typically the normal case is what you would likely to see most often. The flat sometimes comes and the inverted and the humped, these two cases are much less common. Okay, this is another kind of picture because it's very hard to actually have the picture for all of the different maturity bonds in the same picture and track their progress over time. So what this picture does is to take just two scenarios. One in which case you are tracking the yield on the 3-month treasury bill. Okay, so very short-term interest rate, right? Bond which has a very little small maturity. And in the black line, what you have is the yield on the 20-year treasury bond, right? So this is, you can think of this as a representative of a long-term bond. And we can see that the kind of like the gap between the two often changes, right? So in some cases where if you would see that the black line is overlapping with the uh, blue line, so in that case, kind of like you have a flat type of a yield curve, right? But when the blue line and the black line are very different, you have actually kind of like a steep yield curve, right? So just to kind of like also step back and just make sure we understand this graph. So there are actually several things that are here. So you have this blue line, the curve, that is the yield on the 3-month treasury bill. The black line in dark is the yield on the 20-year treasury bonds. You have the gray line also curve. This is basically corresponding to actually the inflation rate. And you have also got down below, apart from the timeline, which is this is the time series data. You also actually have indication of like when recessions happen. So this would be this kind of like blocks that you see down there that would be corresponding to the different recessions, right? So there are several things to actually kind of like take away from this. So for example, if you notice that typically the bluest curve is below the black curve and the distance is pretty large, especially when you are emerging from recession. So for example, after this 1991 recession, in the US, you can see that the short-term interest rate had kind of fallen quite low compared to the long-term run. And in fact, this was the highest gap. Kind of similarly, after the 2001 recession, again, there was this actually gap that emerged between the short term and the long term. And similarly, after the global financial crisis of the late 2000s, you can also see that when kind of like this gap emerge, right? So interesting thing here is to note that kind of like the US, the federal, the monetary authorities actually had kind of like intervened in this market to push down the interest rate in the short-term rate to as close to zero as possible for a long time, right? And it was only in the late 2010s that this was emerging, and kind of like the curve had become flat around early 2020, but this was just before the COVID. And then once COVID hits, again, the short-term rates go down and again the gap emerges, right? So there's a lot of kind of like information in this picture, and it's often curious that to think about, are these kind of like things actually helpful to think about what is the underlying economic condition that is generating this, right? So there is this perception, which is that the yield curve actually contains a lot of useful information in terms of whether the economy is heading for a recession or the economy is about to expand out of the um, kind of like a recession, right? So the thing to keep in mind is that it might sometimes be useful, but sometimes it's just unreliable and noisy signal, right? So wouldn't necessarily want to read too much into it. So for instance, in the early 2020. So in the last few years, we have had situations where kind of like the yield curve was inverted for a long time, but that did not necessarily correspond to a recession actually happening, right? So it's not the case that inverted yield curve always indicates that a recession is happening, right? But typically, we would often find that if you have a steep yield curve, that is often the case after you have got an emergence from a recession. And sometimes inverted yield curves act as a signal, but again, not always of an impending recession, right? So how are these yield curves determined? And can the kind of like the central bank authorities influence it? So, as in most things in economics and finance, these curves are basically determined by the demand and supply for savings and credit in the economy, right? So these are basically the demand for the bonds and the kind of like the supply of these bonds, and this is what helps to determine the structure. So typically, the central banks can influence this kind of curves, but only typically in the short run, right, for the short term maturity. But again, they cannot actually control it per se, right? So they are one of the major players. So by their actions, they can intervene, but again, not to the extent of kind of like completely being able to control it as per will, right? It's not a policy instrument of kind of like things, right? So that's something to keep in mind. Okay, so as we discussed, the upward slope is the most common shape that actually happens for the yield curves. And it's worthwhile to think a bit more about why that is the case and what are the possible explanations, right? So just to fix ideas, let's consider a 2-year scenario. And suppose that the yield curve indicates that the 1-year annualized rate is 5% and the 2-year annualized rate is 10%. Okay. Now you can actually use this to also back out what is the implied 1-year forward rate from year 1 to 2. We have seen these calculations before. This is something that you can do as an exercise, and you can verify that this is around 15.24%, right? Now, the question that one might be interested in thinking about is that why is it that you have the 2-year rate actually higher than the 1-year rate, right? And the strongest possible kind of like explanations or avenues of research are focused around thinking about, okay, maybe the yield curve is upward sloping because the future rates are basically kind of like already implied in the long-term rates. And basically, there is an expectation that there's going to be higher future interest rates, right? So one question is, can actually the yield curve predict higher interest rates in the future, right? Notice that this is different from asking whether the long-term bond is offering a higher interest rate now. The question is whether on the basis of this information, can the curve actually predict what's going to be the actual interest rate that's going to happen in the future for the short-term bonds. Okay. The other explanation that is worth considering is that perhaps the long-term bonds offer a higher rate because they are compensating for risk, right? So we'll actually look into kind of like some of the analysis that people have done when it comes to thinking about which of these two explanations actually might be more plausible in this scenario. Okay, so let's look at the details. So one explanation, as we mentioned, is that the 1 year interest rate next year might be higher than the current 5%, and that's why the 2 year rate is higher, right? So recall that the 2 year rate, if you think about it, is an average of the different, basically of the different 1 year rates, right? So if the 2 year rate is higher than the current 1 year rate, then that would indicate the case that perhaps this just means that the belief is that the 1 year rate is going to be higher in the future, right? So for instance, one prediction could have been that based on the data that you see now, which is this 10% and this 5%, perhaps the next year's 1 year interest rate will be the 15.24%. That one predicted using the forward rates in this perfect world with perfect certainty, right? So if that is the case, this is corresponding to asking if you have this equation actually kind of like existing, right? So where you have got that the 1 year rate and the kind of like are in this line. Okay, so that's one scenario. And the other scenario is that it's not really about predicting future interest rates. Actually, what is happening is that the 2 year kind of like the longer bonds are actually offering you higher rates of return, right? We'll discuss the explanations why that might be the case, but just to understand the ideas. So suppose that we have remembered these numbers, right? That the 1 year rate is 5% now and the 2 year rate is 10%. Suppose you go forward 1 year, okay, and you see next year what's the rate for 1 year and the 2 year, right? And suppose it turns out that the rates actually remain the same as this one, right? So the 1 year rate is 5% and the 2 year rate is 10%. Okay. So in that were the case, then if you had invested 100 units in 2 1 year bonds starting from now. So first you invest it in a 1 year bond from today to next year, and next year again you invest into a 1 year bond from next year to the year after that, right? So if the rate was basically this 5% in both the cases, you will end up getting a total interest of around 10.25 units, right? On the other hand, if you had actually invested in a 2 year bond today, you will end up getting an interest rate which is going to close to 21 units, right? Where do you get this 21 units? This is basically this 10% that you are getting here for the next couple of years, right? So it seems that, this actually ends up kind of like getting higher money compared to the one where you had just put in money in the 2 consecutive 1 year bonds. And the question is why that might be the case, right? So this particular line of thought starts thinking about, okay, maybe the rate of return that you get if you invest in like this like 2 year bonds is actually higher than the interest rate that you would have got if you had done it in two short-term bonds. Okay. So that's the broader question we want to think about, that do we actually have the current higher long-term interest rates predicting higher short-term interest rates in the future? Or is it that they are offering extra compensation for investors willing to hold some long-term bonds? Okay. So let's look at the first hypothesis first. So one of the reasons why interest rates might be kind of like expected to be higher in the future is because inflation might be higher in the future, right? So remember that if you have inflation, that is basically going to erode the value of money. And so the investors might actually say that, okay, we are giving you money today. We know that the money is going to be worth less in the future. So you better compensate us by kind of like giving us higher uh, interest rates, right? To compensate for this loss of value. Okay. So there's one way of kind of like actually thinking about whether this is actually the phenomena that is driving higher rates for the long-term bonds, right? So the reasoning is the following. So if you think about it, this argument that we just gave actually works only for any financial security that pays off in nominal terms, right? So recall this distinction between nominal and real terms. So nominal terms means it's paying off in terms of a currency value. So inflation would be affecting this type of bonds because you have got the currency being able to purchase fewer goods in the future, and hence you need to kind of like compensate that by having a higher interest rate, right? However, if you have a bond which is going to pay out in real terms, which here means that it's going to pay out, let's say, the whatever is the nominal interest rate plus term which would corresponding to the actual realized inflation rate, then you wouldn't expect that this type of reasoning to apply to this type of bond payoffs which are real. And so therefore, the prediction should be that for the nominal paying bonds, then you should have a upward sloping yield curve, but not for the bonds which pay off in real terms, right? So this is the theory. Now, the interesting thing is that there are actually several inflation index bonds as well, right? So for example, in the US, you have this Treasury inflation protected securities, which are often abbreviated by TIPS. So these are basically kind of like bonds which basically pay some promised interest rate. Okay, that would be the nominal part that you have as usual, but they also adjust the payouts by the inflation rate as measured, for example, by the consumer price index that we have studied before, right? So if this is the case where you have got the payments being affected by the CPI as well, then these bonds should not be affected by inflation in our perfect market, right? Because these bonds are inflation protected. So if the nominal yield curve is upward sloping just because of the higher future inflation rates, right, and on the basis of which people expect higher interest rates, then if you have a yield curve based on the bonds which pay out in real terms, then those bonds should not be upward sloping, right? That's the implication of this analysis, right? So we can actually look at the data for this annualized tips rates, different maturities at the same time as we have been looking at the data for the nominal bonds in the previous example. And we can see here that in this case, you can notice that the 5-year rate is minus 1.61, 7-year is minus 1.31, 10-year is minus 1.04, and so on, right? So as before, these are annualized rates, right? And you can notice that a couple of things. One is that this is actually kind of like increasing over time. So this is also upward sloping. And the second thing you notice that compared to before, we seem to have like negative rates, right? So you might be thinking, okay, how come we have negative rates? Because remember, these are basically actually also taking into account that you also have the inflation, right? So if you have inflation, then you can actually have a scenario where the kind of like the real interest rates are actually negative, right? Okay, so actually, if you compare these rates that you see quoted here with the numbers that we had seen before for 2021 for the nominal case, you can actually see that the tip slope was steeper, right? So it seems that, you know, even if you actually account for inflation, even in this case, you have got something which has a upward sloping curve, right? So it seems then that, you know, this theory based on inflation is not enough to explain why you have got yield curve sloping upwards, right? So that's one thing to keep in mind. Okay. Of course, you know, there can be kind of like other explanations for why the short-term interest rates can be higher in the future. It's not just because, you know, inflation might be higher and hence people might be wanting to have higher kind of like demand for higher rates in the future, right? It can be because, for example, you know, they can perhaps be expecting that in future there's going to be a shortage of supply of capital, or there can be more demand for capital because investment opportunities are better, right? So all of these things would actually lead to higher interest rates because of demand supply factors, right? However, and this is outside the scope of our discussion, people have actually looked at it by designing careful empirical studies, and they have found that basically high forward interest rate currently does not actually predict a high future interest rate, right? So this kind of like line of thought, while theoretically a possibility, would be unlikely to be backed by the data, right? Okay, so talking about data, people have also investigated further, and what they have found is something interesting, right? So they have seen that if you were to actually invest by purchasing 30-year bond, okay, you would end up making more money corresponding to the case where you had actually purchased just 1 month bonds for the next 30 year and kept on uh, you know, getting the money and then again investing in like another 1 month bond and so on, right? So what that would mean is that basically long-term bonds seem to be giving higher returns compared to the short-term bonds, right? And so then people have started thinking about what are the explanations for this type of for this type of finding. So one possible explanation is that perhaps, the reason why you have got these different rates prevailing in these different markets is that, you just have different market participants and they have different attitude towards risk and so on, right? So you might have, like, in the long term bond market, there might be some people who kind of like are not that much interested in buying short-term bonds, and similarly, the short-term bonds people, they might not be interested in buying long-term bonds. So basically, they have these markets are segmented, and hence, perhaps that's why the interest rates are kind of like different in the different markets, right? Uh, but what this theory does not tell us is that, why should it be the case that you have got these long-term bond investors who are so scarce so that they would require more compensation, right? Because remember, the implication of this line of thought would be the reason why you have got that the interest rate is higher in the long term bond market is because you have got fewer supply of people who are interested in kind of buying this sort of instruments, and hence the interest rate has to be offered has to be higher, right? Equivalently, you also need basically the short term investors to be so high so that the interest rates are going to be much lower, right? And thus the price of the bonds are much higher, right? So that is one question from the purchasers of the bonds, right? The bond investor side. The other story that this theory would need to explain, and is not clear why it might be the case, is that if you do indeed have the case where the short-term bonds are offering much smaller interest rate and compared to the long-term bonds, then why aren't buyers just selling these short-term bonds, right? So you also need a theory to account for this. And more generally, the idea is that, this seems to kind of like you have this different segmentation of market. This would seem to suggest that there would be role for arbitrageurs to come around and actually kind of like make money by trading with this both set of people, right? Because they can perform the role of a middleman and make money on as well, right? But you don't see that, right? So that would kind of like suggest that maybe this is actually not what is going on, right? There are these other possible explanations, which would be that perhaps, the short-term investors are not very rational, and hence they are happy to kind of like, be compensated with uh, lower returns compared to this other market. That is also very unlikely because you have got this industry being very competitive. So if there are opportunities to make money, you would expect that there would be kind of like people stepping up and actually making those money and closing this gap. There are other explanations, perhaps based on taxes and liquidity. However, these explanations are also unlikely to be true. The reason is because tax-wise, often the treatment for these different short-term and long-term bonds are similar. And liquidity is also typically not an issue, for example, in the US market that we have been discussing so far, right? So these are, while theoretically possible, these are like unlikely to be true if one thinks about it a bit more. And so what the current empirical evidence seems to suggest that the most likely explanation is that the long-term rates are higher because they are acting as a compensation for risk, right? So this goes back to our previous discussion that we had, that one of the sources of risk that you have is that changes in the interest rate have more impact on the long-term bonds, right? Why is that the case? Well, if you have purchased or invested in short-term bonds, you have the opportunity of kind of like not being affected by this risk so much, right? So recall our discussion of when we compared the 1 year versus the 30-year scenario, where we said that, if you have changes in the interest rate, there's going to be a much larger effect on the 30-year bond case, right? But intuitively also, if you imagine that you are holding a 1 month bond, right? And interest rates you find have suddenly doubled by the next month. So one response to this is that, you just wait for 1 month and then you kind of like purchase more bonds next month, right? And you earn the higher interest rate, right? However, if you were instead holding a long-term bond, then that would be leading to you to subject to higher losses because of this interest rate changes, right? And so basically, the short version, of all of this discussion is that maybe the reason why the long-term bonds are offering higher return is that because they are riskier, right? And hence they need to offer investors more return on average than short-term bonds in order to compensate for that, right? And that is what is kind of like missing from our discussion so far, right? So what this would suggest is that probably the next item that we now want to incorporate in our framework, um, uh, which remember we started out by making these strong assumptions. We still have perfect markets, but we have been relaxing these assumptions one at a time, right? So, for instance, this week, what we did is we relaxed the assumption of having no inflation, uh, and we have also relaxed the assumption of now having time varying rates. Probably the next thing that we might want to consider is to consider seriously about thinking about risk and how to incorporate it in our framework, right? So that's coming up in the upcoming weeks because that is a central feature of different aspects of finance. And again, the main reference for our discussion this week is chapter 5 of the book by Ivo Welch, which is as usual available to read for free on the website. And do make sure that you get to practice the problems also there. And as we mentioned, the website also has like for the book has also got resources for additional practices compared to the things that are available in the textbook, as well as the weekly assignments that you're getting. So in this area, at least I think the more practice that you do, the better you kind of like understand these things, become more familiar, and these calculations hopefully become second nature without thinking much about how to kind of like these things work every time you're doing it.